Welcome, guys, and thank you for the support that you're giving us on this podcast, on this space, on this free conversation space where we are able to engage, where we are able to have full conversations, unfiltered conversations, and this is the only place where you have freedom of speech. You can be able to explain yourself. You can be able to tell us what is it that you're thinking from your side, and how are things are going from your side, touching on life, that is the socio-economic fabrics of the society, the economic social being of people. And also at a personal level, we are young people. We know that problems and issues are here and there, and however, at this pace, you guaranteed, and all is settled. I want to usher you in on this podcast that has been taken courtesy of a request by one of our follower who has asked that we dive into matters tax deeper and be able to have to to bring that understanding and to be able to understand what is it that is going on, what's happening, and how, what is tax. By the way, what is tax, and how is tax undertaken and in the space of a public sector. On this podcast, we will be specific and precise to talk about tax system in Kenya. That is the tax system in Kenya, and how many types of taxes are in the Republic of Kenya, and what motivates a tax, or how is a tax motivated, how is a tax administered, who administers that tax, so that we have after that, we will be able now to go deeper on each and every part of tax in each and its own episode, because tax are too many, and the tax are so deep and somehow confusing, especially when you have no interest in them. They will always drain you. So I think up to that point, I want to welcome you. 90% of our viewers are not subscribed to this channel. I want to encourage you that subscribe, even as we bring to you this and more exclusive content touching on the economic aspect of the Republic of Kenya, and what have you, and others. Um, Someone has asked, what is tax, and we go on to be able to say that tax, this is a revenue collected by any government or any given entity. Let's not say use a government, any given entity that collects money to offer an alternative service for that money. Tax, in other term, it's like an insurance cover that you get from a person who wants to administer that cover, but they are administering a cover that at the end of the day you have no capacity to go and claim where there is damages in that cover. So when we talk about a tax system, this is a system where money is collected from the citizens of a given republic or a given country for offering. The core purpose of collection of tax is to offer services, alternative services that are of common interest to all the citizens of a given republic. To be able to offer services that these services cannot be able to be offered by either a private sector or whatever. So the reason why a tax exists in a system, the core of it all is this is money you pay to be able to run a government, because without a tax, it is a tax that brings into existence, and it's a tax that brings into existence of a government. Where there is no tax, there is no government. So when you hear someone say, let's not if in most cases when people want to revolt against a given state, against a given government, they will always be able to advise you that let us revolve or let us revolt. against this government by not feeding them our taxes. Oh my goodness. So, what does this mean? By you not paying a tax, you officially cut the wings and the capacity and the horns of a state. It ceases to exist by you not giving your tax. So that's why during even the time of Jesus Christ, when someone approaches him that why should you pay tax, and he advises the person who is asking that give Caesar what belongs to Caesar, and no Caesar or Caesar, whatever it depends with the English that we have. Uh, uh, so we are agreeing that a tax is what brings into existence of a government. Anytime you see a government officer fueling a gasler, a vehicle, or anytime you see any public officer doing anything in the public space and is a public state officer, the reason why he has the capacity to speak to you in any way that that person wants is because you are the sole employer of that person through your giving of tax. So we are saying for you to understand a tax system in a simpler way is a tax brings into existence of a government. There are very few governments in the world that are powered by natural resources of a given state. That is, we have states that have things like oil, but at the end of the day, if the government says it is only going to rely on their natural resources, it might end up not balancing an economy. And that's something that is complex. We will come to that sometimes later. But a tax system also brings equitability, where people who earn more in a society are expected to pay more so that they can cushion the ones who are earning less. An equitable distribution of wealth in our country. It is done in accordance by using a tax. So that if someone is earning 1 million shillings and another one is earning 100,000 shillings, the taxes for these two people, because tax administration of tax, especially on an income tax, is administered on a progressive tax collection model, where you are going to be able to pay tax from a range of 24,000 Kenya shillings. Then from that 24,000, we are going to calculate that tax in a band of 10% incremental up to capped at 30%. So the brackets that are going to be calculated using the progressive means of calculation. Progressive means it is calculated based on what are you earning, even if it is 10%. But unless you attain the threshold of 24,000 per earning, you can't be able to pay tax, especially tax on earnings. So what we are saying here is that a tax system brings equitability and brings equal distribution of revenue in a given society. So we have agreed what is a tax in a simpler term, not in a book term. That a tax, just know that a tax is what brings into existence of a government. A government exists to collect tax. By the famous words of someone who said, the government does not need to have shares in any business because by default, a government has 30% of your shares of any given business in the Republic of Kenya. What does that mean? Is that a government exists because of collection of tax. Oh my, oh my, oh my. Here we are just injecting facts and injecting what exists. And we are having a conversation, and our conversations are based on facts and not based on rumors or hearsays or hate or political alignments. We will be able to just dive in as they are. Now, what we are saying is that when you come up when it comes a point in life where you feel like maybe you want to take out a government as a citizens of a given country, you don't have to go on a civil unrest and cry in the streets. No, you just agree all of you together and you say we will not be able to pay tax, because it is because of that same tax is when a government exists. So tax system, tax in Kenya is administered by Kenya Revenue Authority. This system has both direct and indirect taxes. Direct taxes, this is where tax is deducted at source by the taxpayer himself. That is a direct system where you pay tax directly. An example of a direct tax that is paid in a system is income tax. Income tax income tax under payee, that is pay as you earn, where your tax is deducted at the pay point. So that qualifies your tax payment to be a direct tax. Then we have indirect taxes that you pay, that you pay through consumption. That is, an example is a person who is a consumer of a vatable, that is value added tax product. You are paying that tax indirectly, because for you, you're just going to the shop and giving 60 or 65 shillings, you're getting your bread and you're going home. So that one, it gives you what we call an indirect tax. So we have two in the tax systems of Kenya. We have agreed that one, a tax system is money that is collected by the government for the main key role, which is misused to some extent, but the key role is to be able to provide services that cannot be left in the hands of private sector. Essential services, e.g. health. Health is an essential service that you are not supposed. In fact, in a serious government system, private hospitals are not supposed to exist because citizens are paying their tax. Essential service in a given system or in a given republic, the most essential one is health. So if health is offered in accordance and in a stringent way how it is supposed to be done, there must not exist a private health hospital. So that is one. Then we have key things like infrastructure. We have started seeing infrastructure where there are people who are encouraging people that look here, you are supposed to get a public-private partnership arrangement to be able to build a road, and then after building a road, you toll that road, which is against the conventions of tax. The convention of tax, why you should collect it, is because you must provide essential service to the citizens of a given republic. So if you are a citizen and you walk on the road and you find a signpost of a road where they have said this is expressway, you are supposed to pay, you must know that sooner and very soon you are going to be colonized by your fellow black people. The primary goal of a tax system is to provide public services and development to its citizens. The primary goal is to be able to provide services and development, not to go for a loan. Because if someone is paying tax, he is supposed to get the value of tax in a given system. That aside, that was not our topic. The key components of tax. We have key components. We will touch on the key components of tax. And one of the key components of tax is income tax. Income tax is tax charged on. Income tax is tax that is charged on at source where someone has earned. You earn, earning is being paid. So you are either paid in form of profit, in form of dividends, in form of allowance, subsistence allowance, per diem allowance, and whatever. So you are supposed to pay tax. So the tax you pay on earnings consultancy fee offered, and you are supposed to pay you're supposed to pay withholding tax. We have two withholding taxes. We have 3% withholding tax and 2% withholding tax. 2% is VAT withholding and 3% is excise withholding. You are supposed to pay income tax. Income tax is payable in several ways. One of the way income tax is paid is through pay as you earn deductions. Pay as you earn deductions is a direct tax payable under income tax. Pay as you earn is deducted using progressive tax structures and is usually between 10% and 30%. That is as of at July 2023 finance bill, where you will be able to pay. You are given a tax relief of 2,400, and then you are supposed to pay tax from earnings from 24,000 going up. 24,000 below, you're not supposed to pay as you earn tax. And then we have something called corporate tax. Corporate tax, this is tax payable by companies, partnerships, and sole proprietors. They pay corporate tax. Corporate tax is payable on profit. That is, you have been in business and it's payable per year. Pay tax is payable per month on a monthly basis, while we were saying pay tax is payable per month, then corporate tax is payable. That is at a rate of 30% for resident companies. Then for non-resident companies, they are supposed to pay 37.5% corporate tax. But they pay 37.7% corporate tax on earnings and associated within the Republic of Kenya. And that office, for it to qualify to be able to pay 37.75%, it must have a residence. It's a foreign but operating with that residence in Kenya. There are companies that are exempted from paying tax, that is in Kenya. So you might get a foreign company, but it has been issued with a presidential directive or presidential exemptions basing on the services they are offering. For example, in Kenya, we have the United Nations Habitat on environment and whatever. They have been exempted. Then we have companies that are foreign companies, but they in a way they operate. They are not operating their services that they are offering. For example, if you get a company, an NGO like USAID, it is based in Kenya because of the importance, or because of the benefits that the country of Kenya will draw from them. So they will not be able to pay that 7.5%. Notably, profit earned by that company, that is that foreign company, it is taxed at also 30% if the profit is associated with the Republic of Kenya. It is payable if that profit is associated with the Republic of Kenya and within. So you can have a foreign company operating within Kenya and South Africa, but while in South Africa you made profit, while in Kenya you made a loss. But when you merge the books of account together, you get that the profit from South Africa cushions the profit you have earned in Kenya. That way, you will not be able to pay the 30% tax, because the profit you have earned is not in any way related, or the earnings that you've gotten is not in any way related to earnings in Kenya. Perfect. Another banter is it is it is rental income. Rental income is tax that is charged on money received by that is a rent residential rental income, and it's payable on a monthly basis at a rate of 7.5%, and it is filed on or before also at the on the 20th. So the earnings that you collect from your tenants at the end of the month, you get what you've received. You calculate. You just go to iTax, and it has been made very simple. Currently, the Kenya Revenue Authority has issued an e-rental, just like an e-teams. They have given you an opportunity to also offer receipts for rental revenue using a system, a system just like that one of e-teams collection. So and we also have commercial rental, that is a commercial rent that is applicable on commercial rent is taxed at an annual applicable rate that is basing on where it is located. But that one for commercial, it is taxed on annual basis. So under rental revenue, we have two. We have residential and we have commercial. For commercial, it is taxed annually. For rental revenue, it is taxed on a monthly basis at a rate of 7.5%. And it's also just fileable on a monthly basis. You file, you get an invoice, then you pay. We will be able to demonstrate and describe how you can be able to pay your tax under the Kenya Revenue Authority platform, how to file and how to pay. We have withholding tax. Withholding tax is deductible at source. It includes withholding tax includes dividends that you earn from a company or from your shares accrued on the profit on your shares. That is royalties. This is payable by having list some lease holdings, and you get royalties from that lease holding. You are able to pay tax. You withhold a tax also. We have professional fees. This is where you have offered, that is consultants fees and what have you. You are supposed to pay tax, and then once the person who has the capacity to withhold your tax is the person who is paying you. And once they withhold tax, it is always good to ensure that they have filed that tax, because if they withhold and they don't file your tax, it might bring you into problems. And this is where VAT people are seemingly they are got up, because you didn't issue an e-teams receipt, but Kenya Revenue Authority writes to you demanding you to be able to pay tax. Why? Because you supplied items. After you did your supply, the person you supplied to did a withholding tax. He withhold tax of 2%. That is pertaining VAT. So in the 16, 2 has already been held by that company. It will remit. So once they remit, the systems of KRA will be able to calculate that if this is 2%, what about the remaining 14? And you will be billed. So that's why withholding tax, it is deductible at source, and it seemingly gives out people who are not maybe ready to follow up on and do the right thing. So once you have issued a receipt, that is a Kenya Revenue Authority e-teams receipt, be able to follow up also, ensure they have done a withholding so that they don't bring you into problems. But in case you've not issued a receipt, just know that the system will catch up with you, and it has been designed specifically to get people who have the capacity and they know how to evade tax. And then rates are dependent on the nature. The nature of, as I earlier alluded, is that withholding tax, it varies. We have that of 3% on VAT, and we have 2% on VAT withholding. That is at source. Then we have 3% VAT withholding. That is if you are a contractor, you've constructed a building somewhere, and we have to pay you based on a certificate, we will be able to charge you two taxes. That is contractual fee at 3% withholding, and then we will be able also to charge you 2% VAT withholding. So, and all of them are based on the percentage total of the amount of the receipt to be paid. So you will find that at the end of the day, this organization is supposed to remit two types of tax on one KRA invoice. So withholding tax is dependent on the nature. Turnover tax. Turnover tax, this is a final tax that is payable within it's payable within between the gross annual sales of cash 1 million and 25 million. That is turnover tax. If you have a gross annual sales of between 1 million and 25 million, you're supposed to pay what we call turnover tax. And the beauty with the turnover tax is not a lot of money because it's only 1%. No, it was increased to 2% also. It's 1% turnover tax, but it's payable between 1 million and 25 million sales. The rates are of that 1%. Perfect. Just a reminder that ensure as you follow this conversation, ensure you subscribe, ensure you tell us what is it that you want us to have a conversation on, and what is it that you feel we can be able to just have this free time and be able to have just a conversation and talk and be able to encourage each other. The beast in the room, we have income tax, which is a key component. Under income tax, we have pay, we have corporate tax, we have turnover tax, we have rental revenue, and we have withholding tax. Number 2 is value added tax. Value added tax, this is a computation of tax that is charged on supply of vatable products. And this tax, mostly it is assumed, or we can be able to say it is an assumption that the commodity that is supposed to be charged with value added tax, these are commodities that are essential, and they have done a value there is the value of that product on the market. It is an easier way where the government can be able to collect something from those products. Service. We have products and we have services. So we have services that are vatable, where they are going to charge you that they have added a value. Then we have goods that are vatable. So under the goods that are vatable, we have goods and services. We have 3. Under vatable VAT, we have 3 computations. We have an exempt tax, that is VAT exemption, that is a VAT that this product cannot be charged VAT, and this product VAT cannot be claimed. We will have a lot of conversation around VAT. It's a very big topic. Then we have zero rated. Zero rated, this is a product that you don't pay VAT, but you have the capacity to claim VAT. We have something called VAT input and VAT output. We will expound on that. VAT input, this is VAT on purchases, and VAT output, this is VAT charged on sales. So on the zero rated, you cannot be able to claim a VAT input. So that, because VAT input is used to reduce your tax liability in a farm. So if it limits you not to claim, then that means you understand that you will be able to pay more. So on an exempt, you can't claim. On a zero rated, you can claim, but you can't have VAT output, but you can have VAT input. For exempt, it's none of the above. Then vatable products, these are products where you pay 16% VAT comfortably, and you can claim also 16% VAT comfortably. The two, they match. So we have one that is full, both sides, each. Then we have another one that is halfway, that is zero rated. Then we have another one that is also 0-0, a draw of 0-0. Another one is 1-1. Another one is 1-0. That is all about VAT. I'm trying to do these things in a very simpler way, and because we are just having a conversation and touching on them, so that you can unaweza ukawa na ufahamu of what is happening. VAT is charged at 16% on vatable products, and VAT is payable, that is on 20th of every subsequent month. And VAT is also not payable, it's filed. It's after you file is when you pay. Paying, when you exit the subsequent month by date 5 by not paying, it is penalized. Then we have customs and excise duty. Customs and excise duty is an important specific goods of that are imported in Kenya that are charged these tax. There are specific goods where you pay the customs and excise duty. Excise duty, this is a tax that you pay indirectly. That is when someone imports things like mineral water, when something imports items like the juice, you are supposed to pay. You're supposed to pay. That is exercise duty. That is Coca-Cola. If you're dealing with the sodas, those are soft drinks, you are supposed to pay exercise duty. That is, be it you are manufacturing, if you are manufacturing them for sale, you are supposed to pay exercise duty. If you are also importing them, if you are importing a mobile phone, the only tax that is charged on a mobile phone, that is at the customs, is exercise duty. That is on mobile phones. Cosmetic products, that is also charged with that a tax of exercise duty. Oh my goodness. Customs, this is import customs duty. We have import declaration fee, and then railway development fee. You have imported products that are supposed to maybe be transported from Mombasa to Malava. These are bulk products and whatever. You are supposed to pay railway development fee, just like people of the fuel who are paying fuel levy. Then that person who is importing items under the customs duty, you will be able to pay railway development levy. Then, as we agreed, we have import declaration fee. Import declaration fee is also done at the import level. That is it. Other taxes and levies. You know, in Kenya, we have taxes and levies that maybe for you might not be aware of them. We have a levy like a capital gains tax. Capital gains tax. This is a tax that is charged on transfer of property. You are transferring a property that you're going to make a profit. When you make a profit on transfer of property, we assume it is payment. Capital gains tax. Capital gains is, what are you gaining from sale of this property? The amount that you gain on top of that product, it is going to be charged 15% tax. So you have a building that you constructed in 1999 at a cost of, and this is where you must have a proof that the amount you've declared as a capital gain on that property, you can be able to support that amount using that is a professional. So you purchased a product at 100 million. Let's not even go to purchasing. The market rate of the product, the property you have, it's around. Let's put it at around. Let's say 100 million. Then you've sold the property at 110. The difference of 10 million is what is supposed to be taxed as a capital gain tax. at a rate of 15%. Then we have a stamp duty. Stamp duty, this is a tax that is put on transfer of profits and shares and stock, not profit but property. So you have paid capital gains on the 10%, then you will be able to transfer that property to that person. For you to transfer, you will pay a stamp duty, but stamp duty is not normally a lot of money. It's just something around 250, 300, 500, depending on what are you transferring. Then you want to transfer shares, the government is supposed to pay a stamp duty while it will be transferring shares from Safaricom PLC to Vodacom PLC. That is one of the most fraudulent deals that we have witnessed in this republic. Anyway, that is for another day. So you will be able to, for you to transfer shares to another person, you will be advised to log into a certain portal. If you want to even transfer a company from one shareholder to another under eCitizen platform, you will be told to come with the stamp duty receipt and upload. That stamp duty receipt, that one is a tax you have paid. Then you have stock. Stocks at the Nairobi Security Exchange. Those are what you're calling stocks, and you're selling your shop and you want to be able to transfer legally. There is a transfer that you do legally. Then there is a transfer that you do with someone who is on TikTok advertising empty shops and people who are going to United Arab Emirates and they need someone to buy the shops. So for those ones, I don't know if you follow due procedure, but if you're following due procedure, you are supposed to pay a stamp duty. Oh my goodness. Significant economic. That is we have affordable housing levy. That is also a tax that is added on your taxes. We have social health insurance fund. It's a levy which is also termed as a tax. We have NITA levies. We have other levies that like NITA levy, railway, not railway. That is road development levy. Recently I heard they are introducing, that is there is something called the air travel levy or whatever for development of the airport, and many others. Then per diems are charged. If you earn a per diem that is more than, they increased, initially it was 2,000, but currently if you earn a per diem that is more than 10,000, you are supposed to be charged what we call above 10%. You are supposed to be charged a tax on that per diem. There is something where we call significant economic prices. Significant economic prices, this is what was initially called digital levy. It is paid at 3% of the gross turnover and what have you. Great. What are the new amendments that have been done on the tax, and the major ones? We have tax laws can only be carried forward for a period of 5 years. That is according to the Finance Bill 2025. That initially people are doing it even to a period of 10 years, 20 years, 30 years. But currently, tax laws can only be carried towards a period of 5 years. If you seek extension, this is where fraud begins. If you want to seek extension, the only person who can extend, and this is power without responsibility, the only person who can extend that is the cabinet secretary. Oh my goodness. You sort it out with the cabinet secretary, is the only one who can extend, and not parliament. Red flag. Digital asset tax was replaced by 10% excise duty on fees charged by virtual asset service provider. So currently there is no digital asset tax. It has been replaced by excise duty that is charged at 10%. Fees charged by a virtual asset provider. So for you, you will not be able to pay that tax. The person who will be charged, if it's on YouTube, it's YouTube that is supposed to be charged that tax of 10%. If it is TikTok, if it is Twitter and whatever, they are the ones who will be able to pay that tax, that is exercise duty at 10%. Transfer pricing to be agreed on with Kenya Revenue Authority in advance. If you want to transfer property, you want to transfer anything, you are supposed to have an agreement with Kenya Revenue Authority this time round. Not you agreeing behind bars and then coming to Kenya Revenue Authority to tell them, we have agreed, we want to transfer this property, we want to do this, and this. Then under the field of betting, that is winning for betting, was replaced by what? Withdrawal. Meaning, you will be paying on withdrawal of money from your betting company, not after you win, you are supposed to pay tax. Initially, they were calculating your win of 20 million or you have won 20,000. The moment you win that money, it is supposed to be paid. The tax here is supposed to be paid. Currently, it is you have won 20 million, you have withdrawn 10 million, you pay 10, your tax will be calculated based on the 20 million that you have withdrawn, not the 20 million that you won. That is it for now. Thank you for having our time. Thank you for taking your time to share with us, to have this conversation. We are blessed to have had a fruitful engagement, and we want to encourage you that kindly just subscribe. We are getting the momentum slowly. As we move forward, we will be seeing how are we going to be able to move forward as a team, all of us together, you and we included. How do we get you to know your views about a topic? Which topic do you want us to be able to discuss? And here we just have a simple conversations that you can be able to understand. We are not doing it in a professional way, because with the more we go deeper, the more we want to confuse you with the knowledge that you already have. So we will do it basically to ensure that we are bringing the message and the conversation home. Oh, so kindly subscribe to our channel, that is Malemo Conversation Space, where we give you the liberty and the opportunity to engage with the freedom of speech and the freedom of expression. And as we have earlier on said and repeated, is that we don't care how, where, and how you are doing what you're doing. What we care is the knowledge you have. You can be able to impact a generation, you can direct, you can guide, and let no one tell you that you don't have the capacity to do what you are doing. You have the capacity, you have the liberty. I want to assure you that your zeal, your energy is what will drive you into realization of the goal that you're pushing and of the goal that you want to attain or achieve. That is it for now. God bless you. Subscribe, share, and let's engage. Let's have this and more conversations together as a team and as a people. Bye-bye for now.